Hello, my name is David Frazier, and from this day forward, I will be making all of the securities recommendations for Insider Trader Alert as Andrew Packer has decided to move on to other things. So, who am I? Who's David Frazier? Why should you listen to me? Well, I've been investing, speculating, and trading in the financial markets for approximately the past 30 years. And for the most part, I've done very well over that 30-year period. Quite honestly, during approximately the first 3 years, I didn't have a clue as to what I was doing. I listened to the advice of a so-called financial advisor at a securities brokerage firm. But for more than 25 years, I've been following my own research and analysis and making all of my own investing, speculating, and trading decisions. Now, I could tell you about schools that I've attended, degrees that I hold. That's what a lot of these so-called experts tend to do. That they love to tell you about the prestigious business schools that they attended, their CFA designations, other things about their so-called credentials. But one thing that almost all of them do, or don't do, probably a better way to say it, and that is they rarely talk about their financial market performance record. Why is that? Well, they don't want you to know about that record. I mean, the fact is, approximately 85% of mutual fund portfolio managers underperform the general stock market indices in any given year. And the 15% that overperform, that beat the major market indices in any given year, they tend to do so for a period of no more than 2 years. And then they underperform. They go into that 85% group that underperform. That's a pretty poor track record. You might as well just put your money in an index fund and just go away, not pay any attention to it. Secondly, the vast majority of financial newsletter writers, wow, you'll see almost none of those guys ever show you or talk about their performance results. Once again, they don't want you to see them because their performance results are horrible. That is, if you followed their advice, you're very likely to lose money. Well, for approximately the past 10 years, approximately 70% of the securities that I've recommended to persons through various services have made money. That's pretty darn good. I think most of you would agree with that. So I obviously make mistakes. I mean, 30% of those recommendations lose money. But, yeah, I make mistakes. No one gets it right all the time, unless you're Bernie Madoff, that is, and they find out you're lying and cheating. So I'm going to make mistakes. But approximately 70% of my stock recommendations over the past 10 years have made money. And on an overall model portfolio basis, just as a reference, if you're a subscriber to our financial intelligence report, well, 4 of the 5 top performing recommendations for that newsletter this year, 4 out of the top 5 were selected by me. For our Franklin Prosperity report, only 1 of my recommendations is currently in negative territory. The other are making money. So I could go on and on about this too. Still that's past performance. That doesn't mean that the same thing's going to occur tomorrow, next week, or the next year. The financial regulators forces money managers to state that the past performance should not be indicative of future performance. How utterly ridiculous is that? Of course past performance is indicative. Why else would an employer that's looking to hire people require them to fill out a job application and to submit a resume? Obviously, they want to know about their past performance. Why is it that professional sports teams always look closely at the statistics of people that they're thinking of hiring for either a basketball or football or baseball team? So, of course, past performance is indicative. But again, that doesn't mean that, I'm going to continue to perform very well, even though I'm confident that I will. So enough about performance. You can read about my bio for those of you that want to learn a little bit about me. And over the next several weeks, beginning today, I'm going to tell you how I approach the markets, the basis of my securities recommendations. Just a little bit today because there's numerous things that I do regarding analyzing the markets and selecting securities. But my overall approach is a top-down approach, meaning that I first look at what's the big picture, and I pay most attention to economic factors and developments. And why is that? Well, it's pretty simple. If a given country if a given country's economy is performing very well, and companies that operate in that economy are going to also probably perform well in terms of the revenues and earnings. So we start with economics. What's the economic environment? And then I go into that economic environment, depending on the environment, will lead me into different sectors and industries, which tend to perform best during different stages of the economic cycle. And then after determining in which sectors and industries that I'll likely invest and advise others to invest, I'll go into the individual companies within those given sectors and industries. And then I look at those companies from a very fundamental perspective. What's their financial condition? What are their earnings like? Or are they losing money? Are they growing their revenues and earnings? What are their cash flows? I study these companies very, very closely. So it's a top-down approach. Secondly, I use what I call the Ted Williams approach. And if you don't know anything about Ted Williams is probably the best, or definitely within the top 2 baseball hitters of all time. I think he's number 16 on the all-time home run list, tied with Reggie Jackson. But guess what? He doesn't even appear on the strikeout list. And I'm not going to get into a big discussion here. As I said, I'll cover this during future podcasts and videos. But for the most part, Ted Williams would not swing at a pitch when it was out of the strike zone. That is, he would sit primarily in cash in terms of investing in the financial markets. And he would only swing with all of his power when the pitch was right down the middle of the strike zone. You know, he had a 20/15 vision, so he's able to determine that very easily. And in other words, he would get very aggressive only when the big picture environment was very positive, as well as the sector and industry environment. Okay, enough about that. So let's move on right now to my outlook for the stock market at this point in time. Well, my research and analysis indicates strongly that stock prices in general will trend lower over the next several months. Now, I know that's completely the opposite of what these so-called experts are saying. You know, these guys are telling us, no, the economy's fine, at least the U.S. economy. Stocks are going to move higher. You should be fully invested. Well, these are the same people that told stock market investors during late 2007 that the U.S. economy was in good shape. Was going to continue to grow at a healthy rate over the next several quarters. That stocks were going to move higher. And yet, from October 10th, 2007 to March 9th, 2009, the S&P 500 total return index, that's the S&P 500 with dividends included, declined by 55%. And individual stocks got clobbered. Unfortunately, I'm sure many of you are aware of that big downturn. And unfortunately, probably a lot of you probably listened to those so-called experts and saw your accounts go down big. Well, guess what I did during that period? I told people during September of 2007, only 15 days before the major market indices peaked, to get mostly out of stocks. In fact, I even advised aggressive financial market participants to go short the market by putting a substantial amount of their money into an exchange-traded fund, an ETF, that was structured to move in the opposite direction of the S&P 500 index. Well, guess what? Those people made money during 2008. Okay. By the way, I could go back to the bear market of March 2000 to October 2002, and the same thing occurred. In January of 2000, I advised investors to get mostly out of stocks. And those who listened to me avoided a 40% downturn in the major market indices that occurred from March of 2000 to October of 2002. Okay, that's great. So you were successful in advising people to get out of the markets on a time at a good time during 2000 and again during 2007. But when did you get them back in? Okay, it's very important. Did you have it just sitting in cash throughout most of the subsequent bull market? No, I didn't. In fact, I got them back in approximately 2 weeks after, well, first of all, approximately 2 weeks before the major stock market indices bottomed during October of 2002. And I got them back again, mostly into stocks. That is, I advised them to get back into the stock market approximately 2 weeks after the major stock market indices bottomed on March 9th of 2009. So, I'm not trying to brag about this past performance. It is past performance. Do I expect to always be right? Do I expect my performance, to continue to perform in that way? I never expect anything. One always needs to be cautious. You can't, you can't get overconfident. You got to be willing to accept, there are times are going to be wrong. So I don't know that stocks are going to move lower during the coming months. I just know that more than 100 economic and financial market indicators that I monitor every month indicate strongly that stocks are going to move lower. So it's a time to be cautious and to focus on capital preservation. Having said that, there is one particular stock that my research indicates now is a really good time to buy, and that is Innovative Industrial Properties. Kind of a strange name or a long name, and a lot of people refer to it as a pot stock, as a marijuana stock. And it is in that universe, but it's not really a marijuana stock or a pot stock. Here's what the company does. It buys land and operating facilities, industrial complexes, that is, for producing cannabis. And then it immediately leases that land and those operating facilities to the producers of cannabis. And the entities that lease the land and facilities are required to cover all of the operating expenses of producing the cannabis. So it puts Innovative Industrial Properties in a position of very, very little risk. It just buys land and operating facilities and then leases that land and facilities to the producers of cannabis. In fact, the company is in a very strong financial condition at this point in time, with its cash alone covering its current and long-term liabilities, that is, all of its financial obligations, by a ratio of approximately 3 to 1. So it's very strong financially. Secondly, the company has grown its revenues and earnings at a very fast rate over the past several quarters. And my research indicates that it's going to continue to grow its revenues and earnings at a fast rate during the months ahead. On top of that, the company pays approximately 4.3% annualized dividend. In fact, the company is structured as a real estate investment trust, a REIT, and therefore is required by law to pay out 90% of its earnings to its shareholders. Very, very strong company financially, will likely continue to grow at a fast rate during the months and years ahead, given what's going on here in the United States regarding legal cannabis. And yet the company's stock price pulled back substantially over the past 3 months, but it's now holding near a major price support level. And my research indicates that it's likely bottom. It's closed today on Tuesday, October the 22nd, at $75. I'm sorry, at around $72. Closed today at around $72. And therefore, I'm advising you, our subscribers, to allocate a portion of your financial market assets to Innovative Industrial Properties at prices up to $75. That should give you plenty of room to get in the stock, even if it were to happen to move a bit higher over the next few days. When I say allocate a portion of your money, I always advise persons who subscribe to my services to allocate no more than 10% of their financial market assets to any given security, and usually no more than 5%. So let's start out at 5% allocation. I advise you to buy innovative industrial properties as soon as you have an opportunity to do so at a price of up to $75 per share. So thank you for watching and listening. I don't smile a lot. I know that I'm very serious. So, I'm not here to get you to like me. I'm here to get you to follow my advice and recommendations because I want to help you make money in the markets. So I am very serious about this. So during the weeks ahead, I'll tell you more about myself and more about my approach. Thank you for watching and listening. I hope to, excuse me, I look forward to developing a long and prosperous relationship.